Happy October, and welcome to another edition of Market Moves presented by Sgroi Lawley. My name is Vincent Scarsella, Head of Research and Investment Development, and today we will be recapping how the market as a whole performed in a very eventful third quarter and discuss what we are looking for as we close out the year. Starting with the stock market, the third quarter saw strong gains for the major equity indices as the Dow Jones rose 5.7%, the S&P gained 8.1%, and the Nasdaq continued its torrid pace of gains since the low in April and saw an 11.4% return in the third quarter. Small caps, however, which are more sensitive to economic data here in the US, outperformed its large cap peers as it saw a gain of 12.4%. Although economic data was mixed, yields came down and the Fed cut interest rates, helping small caps and market breadth as a whole in the market to widen. September historically has been the worst month of the year for the stock market, not in 2025, however, as the S&P posted its best gain in September in 15 years, rising 3.7%. And it was not the only index to post robust gains. The Nasdaq rose 5.7% for the month. Small caps, as represented by the Russell 2000, also joined the party with a 3.1% return. The Dow, although lagging its peers, still saw a positive gain of 2%. The September broad-based gains reflect improved investor confidence as the Fed cut interest rates for the first time this year. Sector-wise, it was more of a split bag, as consumer discretionary, technology, and communication services outperformed the S&P in the third quarter, rising 11%, 10.8%, and 9.6% respectively. With a broad-based risk-on market, the more defensive areas of the market underperformed, as healthcare saw a return of 1.3%, while consumer staples was the only sector in the market to post a negative return, down 2.9%. Moving on to the international markets, this was the first time this year that the S&P 500 outperformed the international index for quarter end. The MSCI ACWI ex-US index saw a return of 7%, slightly underperforming its overseas peer. However, the emerging markets continued its dominance over the S&P 500 this year, rising 11% for the quarter and is now up over 28.2% in 2025, and is looking to outperform the S&P for the first time since 2017. Much of this can be attributed to the US dollar depreciating against foreign currencies, helping the international and especially the emerging markets. A weaker dollar eases debt burdens and default risks, creating a path for more growth, while a stronger local currency curbs imported inflationary risks by reducing EM central banks' pressure to keep restrictive policies. Looking ahead, the factors contributing to US dollar weakness, including US policy uncertainty and rebalancing trends, are likely to persist. However, since July, a new narrative has emerged. Labor market worries and Federal Reserve interviews have caused market expectations for possibly 2 more rate cuts this year. As easing resumes and interest rate differentials narrow, the catalyst for the dollar weakness may become more cyclical. To close on the equity markets, growth stocks continued their outperformance over value. After seeing a 17.8% gain in the second quarter, growth saw another double-digit return of 10.5% in the third quarter, while value, after outperforming for most of the year, saw its lead over growth in 2025 come to an end right as the second quarter ended and cannot keep up with growth in the third quarter. Although still seeing a nice return of 5.3%, it lagged its counterpart by 5.2% as investors became more and more optimistic on the US economy and moved away from value-oriented areas of the market and into growth. Turning to fixed income, Treasury yields eased across the board, helping the bond market as a whole. The front end of the curve, which is more so controlled by Federal Reserve interest rate policy, declined on that anticipation of easing, and the longer end of the curve, which is heavily influenced on projections from the market on where rates are headed, also declined, aided by soft labor data, strong auctions, and projections of more easing by the Fed and accommodative policies. With rates down across the board, the Barclays Aggregate Bond Index saw a gain of just over 2%, while the high yield market and corporates rose around 2.4% and 2.85% respectively. Both high yield and corporates are correlated to US economic data and interest rate projections, reflecting once again investors' belief that easing economic conditions and a dovish Federal Reserve will be an added tailwind to markets. Lastly, from a Treasury standpoint, the longer end of the curve, as expected with rates down across the board, saw the biggest gains, rising 2.4%, while less duration-sensitive strategies rose anywhere between 1.1% to 1.7%. Finally, gold continued its string of outperformance, gaining 16.6% for the third quarter. This was fueled by still strong safe haven demand from central banks across the globe, geopolitical uncertainty, lower yields, and inflationary hedges. Bitcoin also continued its strong performance, up 6.2%, and was fueled by a risk-on sentiment, institutional adoption, and macro uncertainty. To wrap up this episode, there are still conflicting data points coming in as we head into the final months of the year. Much of the fourth quarter and the first half of 2026 can be dictated by how this data comes in. If any inflationary data shows it is sticky or higher than expectations, markets can get volatile, as investors will have to shift how many times the Fed can truly cut rates. Another important thing we are watching is where the labor market goes from here. Since the start of the summer, the labor market has softened, which has made some investors nervous that the health of the U.S. economy is showing signs of cracking. The U.S. consumer makes up around 70% of U.S. GDP, and employment can cause market stress, especially if numbers come in much lighter than expectations. The U.S. government is currently shut down as this episode is being filmed, which could cause some market fluctuations. However, these shutdowns, although stressful on markets, usually end up being a non-event. The equity markets so far have shown that they believe a resolution will get done sooner rather than later, as volatility has not picked up meaningfully. There are plenty of positives, however, as we head into the fourth quarter. Policy shocks are seemingly abating more and more. Deficit spending, combined with Fed easing policy, typically accelerates growth. Equities still have a supportive backdrop. The path of least resistance right now is higher, but bond yields are something to watch, as a breakout in yields would mean volatility. Thank you for tuning in to this edition of Market Moves. If anyone has any questions, please do not hesitate to call the office or visit sgroilawley.com.